Here are some basic examples of what to do for pension plans. Here's some basic information. You have the contributions, or you can call it the funding of the plan. So $105,000 came into the plan, $50,000 was paid out to retirees. The discount rate or interest rate's 10%, and the defined benefit obligation at the beginning of the year is $700,000. The interest revenue on the plan assets was $45,000, and the service cost is $90,000. The first thing you always need to do is figure out what pension expense is. For this example, the components of pension expense are the $90,000 in service cost. Then you've got to have an interest rate that you're supposed to earn. You're supposed to earn 10% of $700,000, so you're supposed to earn $70,000 in interest. But fortunately, you've had a little bit of interest revenue. You certainly would like it to be more, especially if you have to earn $70,000. You don't want just to have earned $45,000, but some years that happens. So when you add those together, the interest you should have earned, less the interest you did earn, tells you how much more interest you need. On top of the service cost, you end up with your pension expense for the year. So we just kind of made a note of the pension expense over here, and we need to make the journal entry. Well, we know that we're always going to debit the pension expense, and we also know that we're going to credit the cash for the amount that we paid. So this year, we made $105,000 towards the plan. What that leaves us with is the fact that we still owe the plan $10,000. That's going to be our pension asset liability account. This year, it's a liability. We owe the plan $10,000 more because we didn't hit our interest targets and we didn't make the money we were supposed to make. So our journal entry is going to reflect that. So what happens is our pension expense is debited for $115,000. The cash is credited for our contribution to the plan. And the rest of the entry is really the liability we created because our expense is more than the cash we contributed. So we owe the remaining amount. We owe the $10,000. We have an account called pension asset liability. It could be on the debit side, but in this case it's on the credit side to make the entry balance for $10,000. That's how you record your basic pension expense. Here's how to do a basic worksheet. Here's the information that you've been given. Your first step is to put the data you've been given into the worksheet column, and we'll do that in a second. The second thing you need to do is compute your interest cost. And your interest cost is your projected benefit obligation times your interest rate. This is going to actually increase your pension expense and increase your liability. So looking at it on the worksheet, the first thing is your service cost. That is a direct amount based on what you were given of $9,000. Your next step is to compute your interest cost. You were told your projected benefit obligation was $100,000 and your interest rate was 10%. So together that gives you your interest cost of $10,000. The next thing you do is you subtract the amount of interest you earned. That was an amount given to you for $10,000. So what happens so far is you've got your service cost plus the interest you needed to earn, less the interest you did earn. So far, things seem to be okay. Your cash contributions to the plan decrease cash, but they don't change pension expense. So we're going to put them in the cash column. Then all we're going to do is add up our columns here. we have a $9,000 positive, that's going to be a debit, an $8,000 credit. We need the matching amount to make the entry balance. In this case, we've got the pension liability. Just like in the previous example, when your pension expense was higher than the cash put in, you ended up with the liability, and that was a credit in the previous example. Well, the same thing here. Well, the same thing happens here, except we're just marking the positives as debits and the negatives as credits. So our journal entry is kind of this part right here in the beginning. From there on out, we're not going to count the pension expense and the cash. We're not going to carry that down. But we are going to carry down the amount from the asset and liability. So we're going to work on the right half of the spreadsheet. We're going to carry over the basic information, and you were told that you had accumulated OCI, or PSE, of $100,000, and that you had projected benefit obligation at the beginning of the year of $100,000. So you've got this first line taken care of. Then what we're going to do is we're going to carry over what happens. You can kind of look at them as offsetting, but it's not always that way. What's going to happen is it's going to make some sense. The company has a pension expense. And what that does is it means we're going to owe the plan. So it ends up being $9,000 as a negative or a credit, if we're going to think of them as journal entries, on this side. The interest cost is going to be $10,000. And as we said, we expect the plan assets to grow. You ended up with actuaries that tell you how much you have to put into the plan each year in order to get you to your target amount. So you need an interest expense to get in there. So we need to have $10,000 in the amount of our liability to pay our pension. So we ended up with that. When you paid off the benefits, that decreased your liability. So if we think of the liability side as the credit side as negatives, when we decrease that, we're going to do the opposite, and we're going to have a debit. Then on the plan asset side, look what happens. We started with $100,000. We got $10,000 more because of our interest revenue. We got $8,000 more in contributions to the plan, and that's being offset by the $7,000 in benefits paid. So we ended up, we had $8,000 in, but we only paid out $7,000 out. So we've now accounted for everything that's here. We're going to count down at the bottom and see what happens with our journal entry. We're going to end up with $111,000 in estimated plan assets and $112,000 in our estimated obligation. That means we're going to end up owing another $1,000. And that's exactly what we had when we recorded the journal entry, was we had $1,000, a pension asset liability amount. So this bottom here on the right doesn't exactly turn out to be equivalent of a journal entry. But we can clearly see that if assets are at 111 and our liability is at 112, that the plan's going to turn around and owe another $1,000. One of the things that happens when you're looking at a worksheet is this is the side for the company journal entry to be considered on. This is the side for the plan assets and liabilities to be considered on. And the carryover is going to move to the other side and switch sides. So we ended up with the $1,000 pension liability. That was here as a credit. Coming over on the other side, the plan assets is going to have to receive that amount as an asset. So we would end up with $112,000 in the plan assets as soon as that liability is paid. So on the company side, we've got the pension expense debit for $9,000. The cash is credited for $8,000, and the pension asset liabilities for $1,000. When that's paid, the pension plan is going to pick up that extra $1,000, and then the pension assets are going to be at $112, and the liability is going to be at $112, and they're going to take care of themselves. And that's a simple entry for a worksheet.